Brace for immediate action. Armageddon was set in motion the moment the CME hit the switch. We're talking forced liquidations. A chain reaction was inevitable. With the stroke of a pen, margin requirements jerked from 9% to 11%. Picture it. Major funds, hanging by a thread of leveraged bets, suddenly found themselves in free fall. Margin calls, the red-hot iron of financial survival, sliced through their portfolios. It began with a memo. In those corporate corridors, this document changed everything. The Chicago Mercantile Exchange would soon enforce new rules that would carve out the weaker links. A precise phrase stands out: revised performance bond requirements. Cold, clinical, and lethal. This was the countdown. Punch through the jargon. Translated, optimizing risk management spells doom for greed-fueled positions. It's not just a margin tweak, it's a guillotine blade whispering down the track at terminal velocity. The music stops and chairs disappear. Picture the ripple. Algorithms smelled blood. Like locusts, they swarmed the data feed and blunted traders with leverage exposure. A liquidity squeeze morphed into a scarcity of buyers. One trade crash triggering another, a toxic spiral sucking in everything. What followed was the collapse of fortified positions. The curtains were yanked from a world shrouded in paper-silver illusions. The hunters had become the hunted. You can't ignore the precedent. Glance back, 1929, the dot-com bubble, 2008. Every crisis reveals the same inevitability. A finely tuned machine promising prosperity, but it always spares the core while sacrificing the many. Why the silence of the watchdogs? The cover-up speaks volumes. Elites had moved. Ample warnings precede the retail apocalypse, but whispers of quiet exits were shrouded in corporate glad-handing. Headlines screamed stability, a media deploy designed to mislead the masses while guiding insiders to safer pastures. React, execute, sell what you think is safe. Liquidate overexposed portfolios, fortify holdings in physical assets, convert vulnerable digital drama into concrete defenses. Hope is no strategy, actions are everything. The countdown ticks relentlessly. The calendar bespeaks urgency. Remember, the system serves its creators, the rich and powerful, not you. Trust in your resolve. The shadow of inevitable cataclysm looms overhead. CME margin requirements surged from 9% to an abrupt 11%. This wasn't just arithmetic, it was calculus with the sharp edge of a scalpel. Every leverage position against futures felt the tremor, an earthquake undermining the fragile tectonics of speculative finance. Imagine traders, expecting stability. Instead, they found chasms yawning beneath them. It wasn't merely a numerical adjustment, it was a strategic rupture. Volumes plummeted, liquidity vanished. Each uptick in margin requirements forced a reevaluation of positions. Stop-loss orders triggered en masse. This wasn't just market turbulence, it was a deconstruction of bullish dreams in real time. With each trade executed, the landscape shifted, owning up to the chaos. Observe the leveraged shares 3x long silver ETF. A victim of its design, sky-high leverage met the painful reality of forced selling. A contained long position morphed into a speculative graveyard. The fund's value spiraled downward as the margin vice gripped tighter. A vivid lesson in the perils of overextension, a paradox where exuberance turned to despair overnight. The algorithms weren't just passive witnesses, they were architects of destruction. Experiencing the pinch of liquidity, they executed orders at the speed of thought. Seconds felt like eternities as computerized minds dissected market weaknesses, transforming human errors into repeating decimals of financial ruin. The systems preyed on short-sightedness, multiplying the nightmare with every trade confirmation. What follows is a breakdown, an evaporation of paper value undermining trust in the future space. Those who had banked on these positions were left in ashes, slashing their forecasts, scurrying for cover beneath the shroud of margin calls. Each percentage shift in margin requirements was a warning, and like all warnings unheeded, nature took its course via mathematical inevitability. Examine, if you will, the vapor trails of history. Crisis after crisis screams warnings unlearned. The Great Crash, the housing debacle, all could be previewed in the reflective surfaces of silver's downfall today. Each was a poisoned well of overconfidence, and yet the thirst for the speculative payout was unquenched. Remember this paradigm. The system was never for us. The market was always a casino run by dealers immune to their own games. They pull the cords, change the odds. Margin increases weren't just defensive, they were a tactical gambit against retail and exposed trading desks alike. Prepare for the next stage. The central mandate is clear. Divest from illusion. Liquidate before you're forced to. Reassign capital into tangible assets. Protect yourself from the maelstrom of paper promises and hidden counterparty risks. No more gambles for crumbs from the table. Days are numbered. Be proactive, not reactive, in the face of the financial tempest. The unseen gears of finance grind mercilessly. It's time to recalibrate your expectations and your strategy. There's an illusion in the market, a deceptive spectacle that beckons traders through a liquidity funnel. Picture algorithms as unseen hunters stalking their prey. The moment Reuters spilled the news, they sprang into action with the precision of a predator in the wild. Traders using leverage became targets. A slip of the CME's margin announcement entered the financial bloodstream, a contagion of certainty abolished. Leverage once promised amplification of gains, a leveraged utopia. Instead, it morphed into an uncompromising adjudicator of losses, hunting down the overextended. Algorithms seized this opportunity. Headlines triggered a cascade of programmed responses, leaving traders trapped in their digital snares. Liquidity narrowed, orders evaporated. The vastness of potential trades shrank into a funnel where only the machine fed could navigate. The paper market was torn apart, a foreshadowing obliterated trust in the tangible. In the shadows of margin calls, algorithms found their strength, amplifying chaos with each nanosecond. They unmasked latent vulnerabilities, exploiting them with each tick, converting past bullish sentiment into present despair. Liquidity became a mirage, a disappearing act both baffling and brutal. This was no accident. Algorithms were the architects, manipulating the market's rhythm. Where once traders moved in herds, they found themselves isolated, unable to contend with the precision of code-driven maneuvers. Human errors magnified into cascading losses, an exponential nightmare. The disconnect between the physical and paper-silver markets was glaring. The physical market, a world of tangible ounces, held varieties of economic truths, sustaining its value against ephemeral promises. Yet on the paper side, Promethean margins manifested to challenge these illusions, leading to structural fractures. What these algorithms perpetrated was a systematic breakdown, a clinical demolition of perceived wealth revealing the true nature of speculative fervor, a siren call for discernment. The futures market exposed its fragility, a house built on assumptions now collapsing under its own weight. The leverage that was silver's ally became its betrayer. An exuberant apparatus crushed under a weight it could not possibly support, a vivid illustration of the market's duality. Every margin call echoed through the chambers of financial greed, affirming a singular, inescapable truth. Trust, once lost, is rarely regained. Turn your vision to solid ground. Divest from artificial distortions. Transition into reality, gold, assets, and other sustainable reservoirs away from these algorithmic wolves. This chapter ends with a warning. Adapt or perish in the labyrinth these systems weave. Protect what remains intact, leverage it wisely. There's a storm outside, driven by entities you cannot see nor anticipate. The imperative is clear. Disconnect from manufactured chaos and rebuild your stability while you still can. Retail traders, a legion forgotten in the corridors of high finance, watched in justified outrage. The systemic anchors designed ostensibly to safeguard, in practice, tilted the scales in favor of institutional giants. Exchanges mechanisms are no guardians of fair play. They are gates, selectively shielding those deemed worthy and abandoning the rest to fend against a tide sculpted by the omnipotent algos. Clad in the rhetoric of efficiency and speed, these mechanisms function as a facade for a deeper inequity. Retail traders experience the blunt force of rules applied mercilessly. Leverage, once a friend amplifying returns, transforms into a ruthless executioner when conditions tighten. Margin calls, calculated to precision, ignite infernos of asset liquidation, irrespective of one's readiness or strategic posture. In every trade placed, in every position held, there lies an implicit trust in the objective neutrality of the market's rule setters. Yet what do they witness? A consistent pattern of disparity. The smallholder, untutored in the esoteric dance of big capital, faces shuttered doors at critical junctures, while insiders step lightly through every opening. Reports from the trading pits tell a tale of systemic priorities. Algorithms follow market patterns supersonically, ensuring the playing field resembles more an obstacle course for the uninitiated. Weaving through this chaotic lattice, they replicate institutional strategies at speeds unattainable by lone traders. The iterant cries of those caught in this mutable structure fall on deaf ears, their despair an unseen and unheard cry in a vast synthetic desert. Deliberate complexity within exchange systems fosters this treacherous deception. Margin rules contorted under pressure reveal a hidden calculus favoring robustness for few, ruin for others. Retail participants, mere footnotes in a vast economic novel, find themselves scripted into roles of inertia and tolerance, even as systemic straitjackets tighten. This structural favoritism fuels a growing resentment, a palpable tension as transparency fades into obscurity, leaving those outside the arena's inner sanctums to piece together their fragmented narratives. Systemic injustice, long whispered, becomes the battlefield of outright disenchantment. Retail perceptions harden in response to this betrayal. Trust erodes under the relentless market eddies. Faith, once abundant, retracts into skepticism. Institutional entities continue their dominion, clandestinely reinforced by the very frameworks touted as equitable. Traditional market instinct succumbs to this manufactured tsunami of imbalance, a new era defined not by humanity, but by preordained manipulations of capital's architects. The path forward is wrought with contradiction. Retail traders, now unhooded from illusions, occupy a precarious juxtaposition of defiance and acceptance. They must illuminate the grid, reveal the strings pulling the marionette. Yet as systems persist unchanged, their battle seems Sisyphean. Adaptation or inevitable marginalization, these are the stark choices stripped bare by this episode as the landscape shifts, forcing a reckoning with the capricious nature of what we've come to label as equity. The atmosphere in the trading room shifted dramatically. Initially, silver prices fueled excitement, a surge driven by speculative fervor. Yet as swiftly as euphoria enveloped the market, it unraveled. Between hope and despair lies a fragile divide, breached with abrupt precision on the floor of the COMEX. Historical parallels abound. Recall the infamous tulip bubble or the dizzying peaks before the 2008 financial descent. Today's traders felt that eerie familiarity, a market high built on precarious foundations, soon collapsing under its inflated weight. Silver experienced this firsthand, an arc from aspiration to capitulation within hours. 2 days of colossal volatility defined this descent, moments where silver brushed the sky only to plummet, creating havoc unseen in recent times. Within mere hours, percentage points tumbled like dominoes in a predetermined crash. Gone were the initial intraday gains, replaced by sharp declines that left portfolios bleeding on the trading floor. The algos sensed blood in the water. Feeding on the frenzy, they intensified the downward spiral. Patterns once stable became erratic, stripping away the veneer of market control. The cascade effect ensued, spilling from automated orders into reality as fear usurped greed, destabilizing what few steadfast positions remained. In hindsight, the eruption seemed an inevitability. Each step upward bore the marks of overleverage and unsustainable momentum. When minor tremors appeared on the horizon, those in the know recognized danger. For others, the revelation came too late as positions swiftly reversed into catastrophic losses, their margins evaporating in a blink. Amidst this storm, the market followed an all-too-familiar script. The retail investor, seeing the climb and rushing in, found themselves caught in a cycle of systemic outmaneuvering, contracts sold at a fraction of intended value, the allure of high leverage becoming their undoing. Professional players, meanwhile, danced along the precipice, their strategies rooted in foresight and deep technical understanding, leaving the unprepared in the categorical dust. The aftermath is palpable. Underneath the surface chaos lurks a sobering reminder: markets capitalize on volatility. The architects of this engineered fall reevaluate in real time, capitalizing on fear and economic uncertainty. The cycle persists. Greed breeds euphoria, breeds panic, and in its wake, the foundation of presumed security crumbles, leaving those unprepared without the hope of a lifeline. In this arena, only the relentless conquer. Silver's volatility stands in stark contrast to the seemingly immutable gold, a paradox yet deeply intertwined. Silver, known for its heightened beta, mirrors and amplifies the fluctuations of its more stable counterpart. In crises, it becomes both a refuge and a trap, swinging between ostensible safety and unchecked volatility. Consider the dichotomy. Gold acts as the bastion, absorbing economic shocks with resilience. Silver, on the other hand, is the acrobat. Its beta far outstrips gold, resulting in amplified reactions to market stimuli. The intricate dance between these metals has historically set the stage for dramatic scenes. In moments of turmoil, silver's sensitivity results in pronounced oscillations. As investors poured into safe havens amid economic uncertainty, silver at first appeared an irresistible bargain. This perception quickly shifted into perilous overconfidence. We're witnessing an entrenched pattern. Silver's price dynamics, accentuated by its beta, saw fluctuations across oscillating spectrums, escalating systemic exposure. When gold inches up, silver leaps. When gold recoils, silver plummets. This is no accident but a programmed response, a systemic echo of prevailing market sentiment. The crisis on the COMEX revealed this relationship in brutal clarity. Gold's guarded movements juxtaposed silver's violent swings. Instability bred from speculative fervor, compounded by margin pressures. A leveraged accelerant on the raw nerves of traders. Here, silver's elemental volatility expressed itself relentlessly. As investors reeled, the message was clear. Silver's nature as a mirror, reflecting gold's strategic moves, remains magnified by leverage's distortion. In essence, the saga is a testament to silver's dual identity. At times it stands beside gold, yet when the tide shifts, it leaves its investors vulnerable, exposed to the whims of market forces beyond control. The inherent risk has always been apparent. Silver's function as a derivative of turmoil casts long shadows over prudence. In this tempest, a deviation becomes paramount. Retreat from silver's tempestuous embrace towards gold's steadiness. Failure to recognize these dynamics ensured losses compounded as gold maintained relative equanimity. Recent events reaffirm a timeless lesson. Silver's erratic nature in context to gold is a reminder of caution. Despite the allure, its volatility is a siren song, a call echoing through each market cycle. Recognizing this duality is crucial. Unlike its golden sibling, silver offers potential, yet this promise is equally laden with peril. It takes a discerning mind to navigate its intricacies, avoiding the pitfalls laid bare by history's repetition. Intraday fluctuations are the silent architects of chaos. Each tick, each microsecond reshapes market landscapes with ruthless efficiency. At the heart of the COMEX crisis, intraday movements illuminated the volatile fault lines in silver's market structure. Visualize this. A trader's screen blinks ceaselessly. Numbers flicker, portraying a tapestry stitched in milliseconds. But those numbers are more than mere changes. They are the manifestation of unbridled sentiment, of all-consuming fear and sporadic greed. Algorithms decipher these fluctuations with uncanny speed. They shape the narrative by reacting instantaneously to every anomaly, every crack in the market's facade. During the critical moments, as the clock's hands dragged towards the close, an unseen choreography played out. Algorithms, having accurately recognized fractal patterns, pounced on panicked sales. Their programming, a merciless dictator, offered no respite to the human souls lost within this throbbing maelstrom. We met a perfect storm, an environment where liquidity vanished as quickly as it appeared. Key liquidity points, terse moments brimming with frenetic activity, allowed an insight into the precariousness of our constructs. Silver's particular susceptibility to these swift liquidity vacuums saw rapid price distortions. In these instances, the market twisted, a Rubik's cube of human ambition versus systematic precision. Traditionally viewed as a refuge, silver bore witness to its own fragility. The interplay of buyers and sellers translated into manic energy, with intraday realities shattering preconceived expectations. Retail investors, mere pawns, their decisions rendered vulnerable to automated directives illuminating their naivety. Even as the day blinked into evening, the aftershocks rippled through back-office servers and onto trading desks worldwide. Tremors echoed as futures reopened after settlements and fresh margins cast their chill over prior strategies. Traders who favored human intuition battled against the impartiality of code, a struggle as old as the market itself. In this spectacle, algorithms directed the course while human participants scrambled to decipher a direction from chaos. What emerged was a narrative of supremacy, where technology subsumed intuition, leaving a cautionary tale about the limitations of our foresight. The aftermath lay bare the relentless logic of the modern marketplace. Inversion remains an ideal until tested by the cold calculus of intraday reality. Geopolitical maneuvers are the silent strings pulling the marionette that is the market. Every announcement, every whispered decision made behind closed doors alters the dance steps of finance. In the crucible of silver's downturn, global politics and monetary policy wove a complex tapestry of influence and reaction, often beyond the grasp of the average market participant. Consider the Arctic tensions, a geopolitical chess game where strategies are played out on the icy stage between global powers, not just impacting energy markets, but rippling through commodities like silver. This tension creates uncertainty, a commodity more detrimental to market stability than any other. Meanwhile, the Cuban oil sanctions stir the pot, injecting volatility and a hint of unpredictability into already nervous markets. Commodities, especially precious metals, absorb these shocks, their prices acting as seismographs of global unrest. Then comes the domestic sphere. In the US, the political climate mutates with the appointment of key figures. Kevin Warsh's nomination as Fed chair served as a lightning rod for speculation and reevaluation of monetary policy direction. A pivot was in the air, a suggestion that the easy money era might face a new set of parameters. Markets, ever sensitive to such shifts, responded with marked trepidation, options unwound, portfolios recalibrated. Connecting geopolitical context to the COMEX showdown is akin to observing war generals moving pieces on a map. Each move reverberates, influencing liquidity, breeding uncertainty, and eventually manifesting in the markets as tangible price volatility. At times, a seemingly small geopolitical event, like increased tensions along the US-Mexico border, can cast long shadows over silver prices. Fears of deflationary spirals battle the specter of supply interruptions, each scenario crafting a narrative of impending doom. The market's consciousness interprets these signals through a lens of skepticism, often exaggerating the impact of policy decisions on commodity prices. This skepticism cascades, prompting abrupt adjustments across trading platforms as algorithms react to new data points fed by geopolitical news, thereby compounding market stress. So unfolds a perfect storm, a frenetic ballet of geopolitical and financial elements locked in a volatile embrace, each action cascading into the next, darkening the horizon with uncertainty. The interplay of Warsh's pivot, Arctic and Cuban sanctions, and the silver market needed only a spark. Once ignited, the conflagration consumed investor confidence, throwing market stability into a smoldering ruin from which no simplistic recovery would arise. In this disquieting tableau, we witness the interconnectedness that binds global factors to trading desks worldwide. The lesson is stark. Positions built on the assumption of market rationality are mere illusions, easily shattered by the ruthless calculus of unfolding events.